Why do some people build wealth quietly while others struggle for decades? Here are 18 rules that rich people follow even when no one is watching. Look at the city skyline behind me. The lights at the top floors? That's where financial systems are built. They don't announce these rules publicly. They apply them quietly. On the left, you see spending. On the right, you see structure. Wealth is built on the right side. Notice how income flows automatically into labeled buckets. That's not accidental, that's design. The clock keeps ticking, and the investment line keeps rising. Time and systems working together. Rule number 1. Systems over willpower. See this conveyor belt? Money moves into investments automatically, no emotion involved. Willpower requires effort. Systems require setup once. Motivation flickers. Automation glows steadily. Which one would you trust with your future? The calendar keeps flipping, but investments grow consistently in the background. Income flows into allocation, allocation into assets, and assets into cash flow. Spending first behavior rises quickly, but investing first behavior compounds higher. Those automatic notifications? That's money transferring before you're tempted to spend it. Rich people design before they spend. That apartment? It transforms into rental income. Assets must produce. Wealth allocation is intentional. Every slice has a role. Rule number 2, cash flow first. Notice the rental income increasing month after month, predictable, steady growth. Multiple income streams feed one central system. That's stability. Even a paycheck is divided strategically: investing, saving, then spending. One income stream creates risk. Multiple streams create security. Business income, rental income, dividends. Different engines, same direction. Salary grows slowly. Compounding assets accelerate. Income is good. Predictable cash flow is better. Rule number 3, they buy time. Time is the only asset you can't earn back. So they protect it aggressively. They outsource low-value tasks. They automate repetitive decisions. They protect deep focus. Time is a non-renewable asset. As sand falls in the hourglass, assets continue rising. Rule number 4, control risk, don't avoid it. Portfolio allocation adjusts as markets move. Diversification forms a protective shield. Reckless leverage destroys. Strategic leverage multiplies. Consumer debt drains. Productive leverage builds. Wealth is risk managed intelligently. Markets dip. That's normal. Rule number 5, protect the downside. Panic leads to selling. Strategy leads to rebalancing. Emergency funds fill gradually, protection before profit. Insurance shields surround assets quietly. Margin of safety creates breathing room. Overexposure amplifies volatility. Diversification stabilizes it. Rich people expect volatility. Short-term swings smooth out over long timelines. Survive first. Grow second. Storms pass, long-term trends remain. Rule number 6, they think in decades. From age 25 to 65, compounding does the heavy lifting. Short-term traders react. Long-term investors relax. Calendar pages flip. The line keeps climbing. Compounding is subtle, but powerful. Like a snowball rolling downhill, it grows gradually. Patience multiplies capital. The clock moves quickly, but wealth grows steadily. Speed builds income. Time builds wealth. Look at this compounding curve accelerating over 30 years. This is what patience looks like in numbers. Small monthly investments stack steadily, forming a growing financial tower. Starting early dramatically outpaces starting late, even with the same effort. Consistency beats intensity. Automatic monthly contributions keep building, even when you're not thinking about them. Rule number 7, separate identity from income. On the left, self-worth tied to salary. On the right, income treated as a tool. Emotional attachment to money distorts decisions. When emotions stabilize, rational decision frameworks take over. Money is a tool, not a status symbol. Notice how social approval fades, but assets continue glowing. Rule number 8, design before you earn more. The budget structure is optimized before income increases. Lifestyle inflation rises quickly, reinvestment rises steadily. This paycheck increase flows directly into assets, not expenses. Income growth without structure equals leakage. A bucket with holes loses money. A sealed container builds wealth. High income does not guarantee high net worth. Net worth equals assets minus liabilities, nothing more, nothing less. Wealth is structure plus behavior. This balance sheet reveals the truth: assets on one side, liabilities on the other. As liabilities shrink and assets grow, net worth expands. Rule number 9. Track what actually matters. Net worth, savings rate, cash flow, return on capital. Tracking expenses alone isn't enough. Tracking growth changes behavior. That financial independence ratio rises gradually over time. Clarity reduces anxiety. Organized numbers replace uncertainty. Monthly reviews turn intention into discipline. Measure, adjust, repeat. Rule number 10. Think in ownership. Consumers buy products. Investors buy equity. Ownership distributes value upward, toward the owner. Dividends flow back automatically into the portfolio. Equity compounds. Depreciation declines. Ownership produces cash flow. A tree produces fruit repeatedly. Consumption only satisfies once. Equity represents ownership in productive systems. Renters pay. Owners collect. Wealth is built through ownership. Income has layers: active, passive, and portfolio income. Notice how portfolio income expands over time while active income stays flat. Rule number 11. Upgrade skills before lifestyle. On the left, luxury consumption. On the right, skill investment. Skill development transforms into higher income streams. Your earning capacity is an asset. Income grows as skills compound. Income follows value creation. The more tools you gain, the bigger doors you unlock. Invest in skills that scale. Rule number 12. Optimize taxes legally. Tax structure determines how much you actually keep. Unstructured income is taxed heavily. Strategic structure retains more. Tax-advantaged accounts grow without yearly erosion. It's not about earning more. It's about keeping more. Gross income means nothing without retained income. Marginal brackets affect portions, not everything. Plug the leaks in the tax bucket. Reinvest tax savings automatically into assets. Optimization accelerates wealth. This ladder represents financial levels: stability, independence, and freedom. Stability is the foundation: emergency funds and controlled debt. Rule number 13. Build stability before scaling. Aggressive investing without protection creates fragility. Strong foundations support long-term growth. Scaling too early increases risk. Stable portfolios absorb volatility better than fragile ones. Cash reserves equal flexibility. Deep roots survive storms. Strength before speed. Rule number 14. Use debt strategically. High-interest consumer debt drains cash flow. Productive leverage acquires assets that generate income. When return exceeds cost of debt, leverage multiplies growth. The spread between cost and return determines success. Debt is dangerous without discipline. Controlled leverage is powerful. Uncontrolled leverage is destructive. Improving debt-to-income ratios strengthens position. Emotion-driven borrowing creates chaos. Structured leverage creates control. Leverage multiplies strategy. This roadmap shows wealth evolving over time. Accumulation focuses on saving, investing, and skill building. Rule number 15. Plan in phases. Expansion increases income and asset scale. Preservation protects what was built. Reactive decisions create instability. Phase-based planning creates clarity. Different phases require different strategies. A sprinter and a marathon runner train differently. Context determines strategy. Asset allocation shifts as life stage changes. Rule number 16. Build networks. Strong networks connect mentors, advisors, and investors. Isolated decisions limit growth. Collaboration expands perspective. Strategic conversations reveal new opportunities. Proximity expands perspective. Ideas transform into opportunities through connection. One tree survives. A forest thrives. Accountability strengthens execution. Advisory input improves financial outcomes. Wealth is a team sport. All 18 rules connect into one integrated framework. Rule number 17. Act before you feel ready. Hesitation loops keep you stuck. Small actions move you forward. Imperfect steps build upward momentum. Small actions trigger larger progress. Momentum beats perfection. Rule number 18. Review and refine. Monthly reviews reveal patterns. Static plans fail. Adaptive plans evolve. Plan. Execute. Review. Adjust. Adaptation protects progress. Long-term growth is steady, not dramatic. None of these rules are secret. Flashy shortcuts fade, structured systems remain. Like an iceberg, most of wealth is built beneath the surface. Wealth is quiet structure. Each of the 18 rules builds upon the others. Applied consistently, they compound together. Systems, ownership, risk control, and time create alignment. Daily behavior determines long-term outcomes. Start with one system. Automate one investment. Improve one decision. Let compounding do its work. Confidence comes from structure. Financial literacy lights up more lives over time. The rules were always there. The only question is, will you apply them? Thanks for watching The Algorithm of Money with Lena. Don't forget to like, subscribe, and share your thoughts in the comments. We're excited to hear from you.